Hello everybody, my name is of course Brian Downing here. We got Dr. Ernie Chan doing a presentation on Beware of Low Frequency. Ernie, take it away, my man.
Okay, thank you, Brian, for again letting me speak at your forum.
No problem. Thanks.
Thank you, everyone, for attending. Yes, the topic today is really about data, but of course, why we want to talk about data is because we want to build better models. So, let's give a little bit background about myself in case you are not familiar with myself. I used to work at IBM as a researcher in machine learning before I went to the financial industry and work as a trader and researcher for Morgan Stanley, Credit Suisse, and a number of other investment banks and hedge funds. Currently, I run a hedge fund, strictly speaking, a commodity pool, and as well as separate accounts through my management company, QTS Capital Management. I wrote 2 books, which are targeting really for retail traders, but of course, certain institutional traders might find interesting materials in them as well. And please check out my blog, epchan.blogspot.com, where there's always a lively discussion going on in the comment section. Okay, so without further ado, let's talk about the topic today, which is essentially, if you are a programmer, you should be familiar with the concept of garbage in, garbage out. Meaning that no matter how good your program is, if the input data is wrong, the output is nonsense. And the same issue is, the same data integrity issue is, of course, crucial also to backtesting trading strategies, which are essentially computer algorithms for generating trades, right? So what is the common problem in this case? In this particular case, the common problem is that the historical data, historical prices that we are using to backtest weren't the actual price that we could execute at back in the days, right? So in other words, the backtest is not realistic because you couldn't actually execute at those prices that you thought you would. And the typical outcome of this problem is that the backtest performance is inflated compared to realistic historical performance. So that is a big problem because we don't mind so much if the backtest performance would be worse than the actual performance historically, because then you would just not trade it. Unfortunately, the common outcome is that it is better. It is inflated relative to the achievable, realistic performance. So you got all excited and thought that you should trade this model and maybe lever it 10 times or whatever, and that can do serious financial damage to yourself and your investor because the live performance will be much below expectation. So the topic today is really how to avoid this unfortunate outcome. So I would do this, explain some of the subtleties of data through 4 example strategies. And the first strategy is a strategy on closed-end funds. It's called the CEF, premium reversion, CEF being the acronym for closed-end fund. This is based on a published paper by some finance professors. You can read it yourself. I've given the reference here. Now, closed-end funds are very similar to ETF, except that for ETFs, you can be sure that the net asset value of the holding of the fund is almost always identical or very close to the market value of the ETF of the fund itself, right? Because if there's a big deviation, the fund sponsor will buy and sell the underlyings in order to maintain this close tracking. Whereas for closed-end fund, there is no fund sponsor that will constantly adjust the underlyings or adjust the market value. It is, as its name suggests, it's closed. Once you created a closed-end fund, it's traded in the market. Nobody will alter the composition of that fund. And so it can certainly develop a difference between the net asset value of the holdings versus the market value of the fund. And that difference is called, for example, if the market value of the fund has a higher value than the net asset value of the holdings, we call it that this CEF has a high premium. Otherwise, we will call it this CEF has a discount. It traded at a discount. Now, it stands to reason that if a CEF has a premium, it should mean revert to a zero premium. Because why? Why should people buy a fund that is more expensive than its holdings, underlying holdings? We might as well just buy the underlying holdings in this case, right? So you would think that arbitrageurs would, short the fund and buy the underlying and wait for the spread to mean revert. And indeed, that's what this strategy is based on. It says that the funds with high premium would have negative returns, while those with discount should have positive return. So that sounds very reasonable. And indeed, that's what the strategy is based on. You just simply rank these funds based on the percent premium and buy the ones that are at the bottom quintile of this premium. Probably these are the ones that have actually negative premium, right? That the bottom quintile probably have negative premium, or in other words, they have steep discount. And also vice versa, short the ones that are in the top quintile in terms of percent premium, and just rebalance monthly. And the reason that these authors did a monthly rebalancing is that they, maybe it's less work, and also, certain data vendors only provide monthly NAV value for the CEF historically. So you don't have data intra-month. So that's why the research was done on a monthly rebalancing. So you can see that this is a very low frequency strategy. You only trade once a month, and it sounds very reasonable. So where do the data come from? Let's see, if they did it right. So the authors got the fund prices and the shares outstanding data from CRISP, the Center for Research of Security Prices. This is sort of the gold standard for historical data in equities. It is a company that's spun off from the University of Chicago Business School. They have very clean data, very accurate data, and this data have no survivorship bias. The best you can get, basically out there. Okay, so that's good. And what about the fund NAV? The fund NAV data come from Bloomberg. Okay, but it's actually obtainable also from CompuStat, and that's where I got my historical data on the NAV from CompuStat. Now they found that the strategy, as I described it, has a Sharpe ratio of 1.5 from about more than 10 years of backtest. So I am decidedly interested in this strategy. It's simple, it makes sense, and has high Sharpe ratio. So why not see if it can really work? So I backtested this again, using the strategy with the same CRISP price data and with the NAV data from CompuStat instead, but at a slightly later period. Okay. So what is the result? Well, the result initially looks very good. I used the closing prices as they did from the CRISP database, and look at this wonderful out of sample performance, right? I mean, their backtest, remember, is ended in 2011. So my backtest, on the other hand, ended in 2014. So there is 3 years of out of sample performance, and it looks marvelous. So supposedly we should be ready to implement it in a live trading program. But I also know that there is oftentimes a problem with using closing price to backtest a strategy. Now here is the same strategy, but I backtested it using the midpoints at the close. Not what CRISP reports, not what Yahoo Finance report, not what most data source would report, but using the midpoint between the bid and ask at the closing time. And that is also provided by the CRISP database. precisely because they know that the closing price is likely to have a problem. So they provide a bid and ask at the close, and I use the midpoint as an alternative way to backtest this strategy, and look what it does to the strategy. It just completely falls apart. Okay, so what is the reason for this dramatic difference? I mean, remember, this is a strategy that only rebalance monthly. It's nothing to do with high frequency trading. Why should we need to have, bid and ask prices in order to backtest this strategy? I mean, and which backtest is correct? Is the one that with a beautiful equity curve, is that correct? Or is the one that had this miserable equity curve, the one that used the midpoint to backtest, is that the one that's correct? So let me explain why the bad result is actually correct. And to understand that, you have to understand a little bit about the about the U.S. equity market structure, and in particular, how the closing price are determined. When you actually execute this strategy, typically you would use one of two kind of orders, an MOC order or LOC order, market on close or limit on close. Why? Because when we execute this strategy, it would not be sensible to pay the bid-ask spread, right? Some of these closed-end funds are not very liquid. They are not Google or Apple stocks. They can be quite illiquid. So the bid-ask spread can be quite wide at the close. We don't want to pay the bid-ask spread. So typically, if you use a MOC or the LOC order, you would be able to participate at the closing auction. And the closing auction typically means that you get to match, get your order executed at the midpoint between the bid and ask. You don't have to pay the bid ask. So, but if you do that, what is the actual execution price? Well, the actual execution price will be not the so-called closing price that Chris report or Yahoo Finance report, but it would be what is called the primary price or the official price or the auction price. Why? Because the Yahoo price, what people typically call the consolidated closing price, which most historical data set use, such as Yahoo Finance use, are the price that are the last trade on any of the exchange. Now, in the US, there are over 50 market centers where a trade can occur for a particular stock. IBM can be traded in one of more than 50 venues. It doesn't have to execute at New York Stock Exchange. It doesn't have to execute at NASDAQ. It does not have to execute in Arca, BAT, or Knight, or whatever places that you think of. It could execute in Philadelphia. It could execute in Pacific Stock Exchange, all kinds of places that most of them you have never heard of, not to mention dark pools. So the closing price that is captured by most data vendor could be a price that it could be that of a trade that happened in any one of these over 50 venues, and none of them is guaranteed to be the price that you can execute on historically. The only price that you can guarantee that you can get executed at, almost guaranteed that you can get execute at, is the auction price or the primary exchange price or the official closing price. And that price is seldom reported in any of the historical data that you can obtain cheaply. Well, to understand a little bit better for the the U.S. stock market structure, I recommend this teaching notes from NYU professor Joe Hasbro. He's a world expert on market structure research, and he has generously provided his teaching notes online, so anybody can read them. And it provides a very clear picture of what is happening at the close. So, like I said, if you are trying to participate in the auction to avoid paying the bid-ask spread, you have to use the limit on close or market on close order, and that order will be executed at the auction price, not at the price that necessarily what the Yahoo reports. So therefore, we should use the auction price to backtest instead of this consolidated price, which no one can guarantee you can execute at. And how do we get this historical auction price? Well, you can certainly buy from the primary exchange. That's going to be expensive. You can subscribe to Bloomberg. They provide two sets of price. One is a consolidated close. The other, based on the particular exchange, you can get the closing price from a specific exchange. You can tell Bloomberg, give it a particular symbol name or a particular suffix. They will show you the closing price from that particular exchange. But Bloomberg is also expensive. It costs you over $2,000 a month and a 2-year contract. So I don't use that now. I used to have it, but I don't anymore. And then the third one is that one that I use is the CRIS data set. Again, it's not the closing price that I use, but it's the midpoint that I use. So this midpoint is what I use for backtest, and that's what I use to generate that awful-looking equity curve. Now, that's a fourth option that I should mention, and that is we can actually use tick data. Now, why should I use tick data? Well, if I could just use the midpoint from CRIS, because CRIS data actually is also expensive. I only able to get it free because of my academic affiliation, because they license it to business schools, and any professors or adjunct lecturers or whatnot can use that data for research. But if you are not affiliated with a business school, well, you have to buy that data. Again, that is a 5-figure proposition. So actually, for retail trader, there's actually an option where you can get this data quite cheaply, and that is renting a tick database from QuantGo. Our firm use it, so I oftentimes recommend it to other retail traders. QuantGo.com rents you this tick data at 1 millisecond frequency, but what's more interesting is that these tick trades have a flag called a cross flag. It will tell you whether a particular trade is the closing option or in fact the opening option, and therefore you can pick out that particular price at the closing cross, and use this for backtest. And that is a much more economic option. It only costs a couple $100 a month for rent, and you don't have a long-term contract to fulfill. So that's an alternative way to find the data to backtest. Now, actually, I see that there are some questions already on the chat window. So let me actually address them, because this is a good time, because it.
Ernie, like with that QuantGo, could you type that up in the chat box? And I know that Bruce had some questions as well. He asked.
Well, I'm looking at the first question. Looks like it's from let's see, from who? Let me get the chat window larger. No, it can't go larger. But let me see.
Yeah, that's the problem with GoToMeeting. Yeah, Bruce, you had some questions. I know that. If anyone else has some questions, just type them up in the chat box. That's what we usually do. If you want, I can always unmute you. Just let me know. But just type it in the chat box.
I have a question.
Go ahead.
When do you execute the algorithm? At the end of the last minute of the trading day, or someone else?
Yes, the auction that we are talking about is the one at or after 4 o'clock. So this strategy was executed only at the close. But of course, as I mentioned, if you want to participate in the auction, you have to send in an MOC or LOC order. In order for you to send in that order, the exchange rule says that you have to send it in about 10 minutes before the close. At least for NASDAQ, you have to send in 10 minutes before the close.
So you run the algorithm 10 minutes before the closing, and then do the trading.
That is right. Yeah. Yeah.
Would that affect the premium of the company?
Yes, that is another good point. to really backtest it completely accurately, you actually have to use the prices at before 350 to generate the trading signal, and then see what they execute at the 4 o'clock. So yes, that's another subtlety why even a seemingly simple strategy like the monthly rebalancing strategy, you have to you have to really use tick data to find out the price before 4 o'clock. You can't use the 4 o'clock price because by that time it's too late to enter the order. So that's another subtlety that derailed the backtest that the author used, and actually derailed the backtest I use as well. But even without that, taking into account that subtlety, just to assume that you can execute right at the close, to generate the signal at the close, it still produces a terrible equity curve.
Oh, there's another question that came in, Ernie, from Steve.
Well, let me see. There are people who ask questions earlier on, so maybe we should start. Answer this question in order that they asked to be fair to everybody, right?
Yeah, I'm just. Go ahead.
Do you see? What's the first person who asked question?
The only first question I got was from Bruce asking about questions. Also, there's just some commentary from myself.
Mm-hmm. Okay, so I think Dave is the next question. Yes, Dave said that the NAV could rise to meet the premium. That is correct. Yes, but this strategy doesn't care so much about NAV, but they just care about their. That is a very good point, but it seems that they are counting on the market price to mean revert because they're shorting. They can only short they're implementing this strategy by trading the fund instead of trading the underlying. So they are not trying to take advantage of the mean version of the NAV.
You know what's going on? I think Ernie, these people are probably sending you privately questions because there's an option there. So I'm not seeing the questions. So not everyone's going to see those questions that are being sent to you privately. Yeah, I think that's what's going on. So that you might get some private messages, but it'll just say under the chat. I'll say to Ernie, and that's just to you privately. So there might.
Well, that's certainly a problem. Yeah, please don't send me private message because if you send me private message, no one else can read it, and when I answer them, nobody know the context.
Yeah, and same with the video playback too.
Yeah. Okay, so let me scroll down. So let's see what happened here. Dave asked a question about this strategy uses closing price. Yes, that's the same question that Wei, the same issue that Wei has asked. No, actually, there's another point that Dave has tried to make. Is he said that not good to have a heavy weighting in a low frequency strategy unless you are trading millions. I'm not sure what you mean by heavy weighting, Dave. Dave, if you don't mind repeating your question to the classroom, if you have a mic, if you don't mind repeating it, because I don't understand what you mean by heavy weightings.
I think he's referring to obviously when you allocate certain amount of weightings on the portfolio, maybe.
Well, this strategy assumes that we have equal weighting on each fund.
Okay.
So I don't understand what exactly you meant by heavy weighting. If you don't mind elaborating on that, Dave.
We can always open it up as well if need be. I think Steve had a question, and there was a Bruce question as well.
Anyway, Brian, there are too many questions on the chat window, so I suggest that maybe you can curate some of them.
Oh yeah, there's a ton.
Particular day, if you are sending me private messages, I cannot read them because there are too many. And so if you don't mind sending it to Brian so that he can repeat it to me, or just everybody can can benefit from them.
Exactly, or just send it to everybody because you'll have that option. Well, I have Steve, Bruce, and then Dave. Someone said capital allocation to Dave's question. Dave came back with, Ernie, you didn't get the mechanics of the strategy. So that's what Dave said. So my question was around the mechanics. That's what he was referring to.
Okay, let's go back to a few slides before. That's where the mechanics is talk about. Well, first of all, the exact details is in the public domain. You can read this paper from Pedro. But the mechanics simply is that they assume that at the close of every month, you are able to obtain the premium and the discount of a fund. The premium and discount, of course, is the difference between the market cap and the NAV. And the NAV is more tricky to get. Actually, you can get it only after the close. So when I backtested this strategy, I assumed that I would trade at the close on the day after the NAV was published. So if the NAV is published today after 4 o'clock, I assume that I can rank these funds tomorrow using the market price near the close of tomorrow, while the NAV remains unchanged from the previous announcement, the previous days after close announcements, and rank this EV and then enter a MOC order for the top quintile as well as the bottom quintile. So that's the detail of how we run the backtest. So that's the one crucial detail that I didn't mention, which is that the NAV, of course, are announced only after the close. So you need to use the previous day's announcement to generate the signal for the rebalancing today. Yeah. Okay, you're welcome.
We got 2 more questions you want to take. There's one from Steve and Bruce. That's all I have so far. Do you want
sure.
And then let you continue on your way with the presentation. Okay, so the first question I got from was Steve. He says, I've purchased data. Some of the data was very bad, and in that time was missing in some areas, and some data showed the lower high. Let me repeat this. And some data showed the low higher than the high, and similar data errors. This was about a decade ago, so may not be equivalent to current data sources. I guess that's a comment. You want to try to tackle that?
Right. That's actually a prevalent problem with bar data. And so actually, what your experience really fit very well with the theme of this talk, which is bar data is no good. If you want me to summarize the gist of this talk is that do not use bar data for any backtest.
Yeah. Bruce, I think Bruce asked me a question if this is being recorded. Yes, and here's a question I know we got from Paul Cottrell, and now Bruce is, are these slides going to be available online? I mean, I can put them on my meetup if you choose to do that.
Yes, you can certainly do that. As these slides actually are already online if you go to the quantopian.com website. I mean, as I mentioned, this is a talk that I gave at the Quantopian conference a few weeks back, and they have put that up on their website as well. So yeah, by all means, Brian, you can put it up on your website as well.
Okay, and Dave came back with bar data is not good unless you develop an effective strategy with it. So, go ahead.
Right, you have to take your chances. Of course, you might get lucky with the bar data and you got a good strategy that works. I used to use bar data and I did not go bankrupt, right? So I'm still making money in the past when I use bar data. But I also found that there are several occasions where we use bar data to backtest the strategy, which looked marvelous, and we traded it and it lost money. And then we backtested it again using tech data, and we realized why it didn't make money, and it's because the bar data was no good. So you can certainly use the bar data to backtest, but you're taking chances.
Yeah. You want to continue with your presentation now? I don't.
Okay.
We cleared it all up so far.
Sounds good. Yeah. So the second strategy is a strategy that I actually talk about in my book, Algorithmic Trading. It's a strategy that I call the opening gap reversal strategy. And the idea is very simple, and it's widely practiced by a lot of traders. It's this is not by any stretch of the imagination some holy grail or secret. The idea is that if you look at stocks that the gap return, if you compute the gap return of stock, which is by definition the return from the previous close to today's open, okay, you form this return called gap return. The stock return tends to mean revert from that gap return. So in other words, if the stock gap up very high, it's likely to go down throughout the day, and vice versa. If the stock price drop a lot, gap down a lot, it tends to go up throughout the day. Okay, so that's well-known phenomenon. But of course, you can apply all kinds of bells and whistles. The strategy, filter out the stocks that just an earning announcement, do this and that to adjust the return, hedge it in every which way. Some of these adjustments I've talked about in the book, and others I'm using myself, and I'm not telling other people who have developed other technical theory that are superior to mine. So they're all kind of variations that you can apply to this basic strategy. But the basic strategy is that you just basically compute this gap return, and then you buy the 10 stocks that has the most negative or the lowest gap return, and you short the ones that has the highest gap return. And then you exit at the close. Very simple, right? It's very simple. And I backtested it with 2 years of data, and I traded it live in the middle of that period in 2013. And here is the comparison. You can see that the backtests look marvelous, as most backtests are, and the live trading, which is the red line, is still positive over the trading period, but is certainly much lower return than the backtest. Now, I shouldn't actually call it backtest, because the time period where the two curve overlap, that's a walk forward test. The blue curve actually represents a blue walk forward test, meaning that I'm using the historical data to backtest it, but it's actually, at that time, the model is fixed. We are not changing the model. We are really running the model live, except that the data used is historical data. Whereas the red line is the result of live trading. Okay. So what is the reason that the backtest is so much better than the live trading? Now, let me make a few comments also about our backtest. The backtest already used the midpoint and close. So we are already gotten rid of the previous issue that we just talked about. We are actually using pretty much the auction price. We are not using the consolidated close for this backtest. And so that is not the issue here. And also we included the commissions, very generous commission that we assume 5 basis points per trade. So commission is not the reason. Slippage, we are not trading big. We are not trading a million per stock. So that's also not the reason that it moved the market. We're trading quite modest size. Certainly it's just a fraction of the closing volume. So what is the reason still, after eliminated all this culprit, that it's underperformed? Well, the most obvious one is that the opening price is also problematic. Unfortunately, the CRIS data set does not provide the opening bid ask. It only provides the closing bid ask. So we are forced to use the consolidated open to backtest this strategy. And that, of course, introduced a problem, just like using the consolidated close. But more than that, just like Wei had pointed out earlier in the context of the closing execution, to submit a market on open or limit on open order, you also cannot submit it at 9:30. You have to submit it 2 minutes before 9:28. That's the NASDAQ deadline for the LO and MOO orders. So to backtest this properly, you have to use the price at 9:28. You cannot use the price at you cannot actually use the open price to generate the trading signal. But of course, at 9:28, the market is not open yet. So what price do we use? Well, we can only use the bid ask. But unfortunately, at that time, the midpoint between the bid and ask can be quite different from the open price. The difference is much bigger than the close price situation. The close price situation, because the market is extremely liquid at that time, the spread is actually quite narrow. But at the open, the bid ask is quite wide and the slippage is quite substantial, especially in that 2 minutes period. It can move quite a bit from 9:28 to 9:30. The prices. So that is very uncertain. I mean, if you're using 9:28 bid ask price backtesting strategy, the result will look very different than if you are using 9:30 prices. So that's another reason why it relates to the theme of this talk, which is low frequency data, bar data is not that good, especially if you are executing it open, and even if you're only executing at the open and close, you still have to get bid ask data at the very least. Maybe not necessarily tech data in this case. You can certainly get 1 minute bar data, but you do have to get the bid ask data at 9:28. The trade data won't work at all for this strategy if you want to have an accurate backtest. So before we go on to the next example, let's again take some questions here.
Yeah, Wei had a question here. There's two. Wei and Ivan.
Okay, so yeah, okay, actually I can read them now.
Okay, cool.
So Wei asked, what are the candidates? That's S&P 500, yeah. So we rank the S&P 500 stock, but certainly you can extend the universe. It's not too critical that we use S&P 500. We just choose it because of the liquidity. Dave asked another question, why bid-ask spread? So Dave, so that's not the reason. So as I said, this is the most liquid stocks in the US. It is not because of bad choice of instruments. The bid-ask spread, even for the most liquid instruments, before the market open can be quite wide. That's unlike the bid-ask spread, of course, before the close. So next question is from Ivan. Open has much less volume. That is correct, yes. That is precisely the point that I'm trying to make here. The open is much less liquid than the close, and that's the reason why the bid-ask is quite wide at the open as well. Okay, so that's all good. So let's move on to the third strategy. This one is taken from the futures market, not the stock market. And it's a momentum strategy. The first two strategies were mean reverting strategy, and so some people might say, well, the strategy didn't work with this kind of data because they're mean reverting. And my point here is to illustrate that this is not just because it's mean reverting. Even if you have a momentum strategy, you oftentimes still need tech data. So so that's the purpose of this third example, is to point out that it's not just a consequence of mean reversion. So what is this intraday momentum strategy? It can be applied to a number of different futures. I have tried on gold, for example. You can also try it on soybean or on a gasoline future, whatnot. So the algorithm, again, is very simple. It's you can use it to rank. Okay, so you first of all look at the previous day trading session. The trading session is defined as the open outcry close to the next day's open outcry close. So previous day trading sessions means the prices from the previous day open outcry to today's open outcry. So you take that 24-hour period, you rank all the trades or the quote. It doesn't matter. You can rank trades or quotes. The result is not going to be very different. So you get a sort of histogram of this trade from the previous session. And now in the current session, you monitor the trade. If the trade is, the last price, let's say you're using bar data to backtest, so that would be the last price. If the last price of a bar is above the 95th percentile of that histogram, you will go long. So this is a momentum strategy, right? So if it goes up very high, you go long, and then you would only exit if the price dropped to below 60 percentile. That's a stop loss. So this is a classic momentum strategy. You buy high and sell low. If you buy high and it keep going up, you would never exit, right? So there's no profit cap in this strategy, but there's a stop loss. The stop loss is when it drops below 60 percentile, you would get out of the position. If not, if it doesn't hit the stop loss, you just keep holding it day after day. Of course, day after day doesn't mean you will never exit, because every day you are doing a new percentile. So today's 95th percentile is a different price from tomorrow's 95th percentile. So this strategy will get out at some point, but it might hold multiple days. And the same opposite entry and exit signal occur for the short side. So, okay, so now we compare the backtest on the 1 minute bar from E signal, and that's using back adjusted continuous contract, and we compare to the backtest using the 1 millisecond PBO pulse that we rented from Quantico. Now these two, you might say, well, this is an intraday strategy, right? So obviously we should be using tech data to backtest. After it's an intraday strategy, but that not necessarily, because this strategy on average only trade one round trip a day. It's a very low frequency strategy. Even though it can enter intraday and exit intraday, but as a matter of fact, if you backtest it using 1 minute data, it shows that it only executes maybe one round trip a day. It's not at all a high frequency strategy. So in theory, or you might think that 1 minute bar should be good enough for backtesting this strategy. So let's see what the result looks like. The result, in all cases, in all futures, show that the 1 millisecond data gives you a negative return, whereas the 1 minute data gives you pretty decent return. And of course, the return depends on what instrument you are. But for GC, it essentially generates a strategy that has a Sharpe ratio of 1. But if you are backtesting using the millisecond data, the tech data, it's completely negative. And the reason for that, if you look closely at why, what's the difference, is that the 1 millisecond data shows that the strategy flip-flops rapidly within 1 minute. And what this flip-flop means is that there's a drastic change of the last price back and forth. It's a rapid mean reversal of prices within the 1 minute bar data. And therefore, the 1 minute data does not capture it at all, because by the time you look at another snapshot, the price has been reverted to the original. So you backtest the strategy using 1 minute data, you would never get it. But if you realistically, if you're using the 1 millisecond data to backtest, you will see this rapid reversal. And because this is a momentum trade, whenever there's a rapid reversal, of course we lose money. And in fact, we actually traded this strategy live. That was before we have the wisdom that we should check out every strategy using tech data. We backtested using 1 minute data. We thought this is all okay, it's great. And we traded live, and we see this loss, and it doesn't compare at all with our backtest. We run a walk forward test, and it doesn't make any sense. So we decided to go ahead and backtest it using tech data, and it reveals this kind of flip-flops. And we gain the wisdom that even though the strategy exit and enter only once a day, you still have to use 1 millisecond data to make sure that it doesn't get caught in this kind of rapid reversal. Now, some people might ask, well, why don't we also trade live with 1 minute bar data? Well, that's not a good solution, because this is going to be arbitrary. If you had caught, who is to say that the 9 o'clock or the 10 o'clock data starting at 10, the 1 minute bar data starting at 10 o'clock is the set of bars you should use. Why not 10 o'clock plus 10 milliseconds or plus 3 milliseconds, right? So that's just good luck maybe that you backtested using 1 minute bar and you didn't got hit by these rapid reversals. If you had used the minute bar data that started at 10.003, then you might get hit. So that's not a reasonable way to avoid it. The reasonable way to avoid it is to don't trade this strategy. So, but before I move on, let's take some questions.
Yes, there was that comment you talked about, but there's two previous, one from David again, and then Ivan. Do you want me to just read them out?
No, I can see the question now.
Okay.
That's right. Yes, that's what we agree. Yeah. So this is indeed a case where certainly is the rapid reversal could be due to high frequency trading or smoothing or layering or whatever people call. So yeah, definitely once we see this reversal using 1 millisecond data, we decide this is not a good strategy to trade. But that's something you cannot tell if you use the bar data to backtest. So even said that the IB has a decent execution at the close for the most liquid. Okay, I'm not. Yes, I mean if we are only trading Google and Apple or the top 100 market cap stocks, chances are the consolidated close may not be so different from the auction close. But in the case of the closed-end fund situation, we are not, right? Some of these closed-end fund can be not very liquid, and particularly, and even for the opening gap strategy, we are trading S&P 500. The last 100 stocks, the least liquid 100 stocks in that S&P 500, already you can see sometimes significant difference between the auction and the consolidated close.
And you...
Dave said that the solution would be write the backtest execution on tick data. Yep, that is right. But the signal on the naturally normalizing property. I'm not sure that is the right approach. As I said, if you are executing on minute data, it could be pure luck again that you pick a set of minute data that does not have the flip-flop. But who is to say that the flip-flop had to occur in between the minute bar? It could occur right at the open of the minute bar. So I actually agree with your previous judgment, which is that that this is not a good strategy to trade whatsoever because of the spoofing or the layering phenomenon that people have been talking about lately. Yeah. Okay, so moving on. Example 4 is about penetrating ETFs, and this is again a mean reversion strategy. You pick two ETF like EWA and EWC that are very co-integrated, and that therefore the spread should be good candidate for mean reversion trading, and we can apply a Bollinger Band strategy. I talk about this kind of strategy a lot in my book, so I'm not going to belabor it. And again, the issue is really about the exact data to be used for backtest. If you're backtesting it now, in this case, I typically backtest it on the closing price. Whether you use auction or consolidated price, it typically give you decent results. So the issue in this example is not about the closing price, but it is about a slight alternative version of the strategy, namely that instead of executing at the close, you might say, well, why do I have to execute at the close? Why not execute intraday, right? If you're using a Bollinger Band, so you should exit whenever it hit the upper band or the lower band or the moving average, right? Why wait until the close? If you see profit, exit, right? No harm to exit when the spread is mean for intraday. You might miss that opportunity intraday, and then you wait until the close, and the spread might widen again. So, in theory, you might say, okay, it would be great if we can, backtest. In case you don't have tech data or even intraday data, you say that I backtest a mean reverting strategy on the daily prices, but I execute this strategy intraday so that I can capture any profit opportunity. That sounds like a logical way to alternative to execute this strategy. So indeed, we tried it. Okay, and the result, and we tried using Interactive Brokers live data feed to monitor intraday prices to find out opportunity for entry and exit. Now, again, the live execution result intraday is very poor compared to the backtest using only end-of-day data. And the reason, again, is due to the flip-flopping. There are, just like in the case of futures, in the stock, we also have this case of rapid mean reversion. Now, you might say, wow, this is a mean reverting strategy, so mean reversion should create profit opportunity for us, right? It would be great if we get in at a low price and then exit at a high price within 1 minute. Wouldn't that be great? Well, unfortunately, in this case, the apparent sudden drop in price vanishes by the time you send in an order. So these are the so-called mini flash crash that people talk about. You see the data, you see the spread widen, and you send we trigger an order because whenever the spread is wide, we trigger an order to short the spread, right? And but by the time your order hit the exchange, that price has vanished. It is truly a millisecond phenomenon. So that price only holds for a few milliseconds by the time your order hit. Maybe 10 milliseconds or 15 milliseconds later, it's gone. So you executed a trade at a much worse price than was indicated, than the trigger price, and it causes losses, just like in the case of futures. Now, this is a particularly serious problem with spread trading, with pair trading, and the reason is that in the case of if you're only trading one instrument, a small change in the price may not be enough to trigger a mean reverting trade. Right? You have a Bollinger Band, and maybe the Bollinger Band is set at 1 standard deviation or sometimes 2 standard deviation. It is unlikely the price of one instrument will drop 1 or 2 standard deviation in a few milliseconds and mean revert. That would be truly egregious. But we are not talking about trading one leg. We're trading the spread. The spread itself might be just maybe 10, 30, or 20, or 30 basis point wide, 30 basis point of the price of one leg. So a mini flash crash can certainly change the spread by 30 basis point. So because the spread is the difference of 2 large numbers, the spread itself is very small. So a small percent change in the price of one leg can cause a large percent change in the spread itself. And because the trading signal is triggered by the spread, not the leg, the price of each leg, that happens very often. This kind of mini flash crash that is a 15 to 30 basis point change in prices trigger signals in the spread quite often, so much so that trading this kind of mean reverting strategy intraday doesn't work anymore. It trigger erroneous order, and in fact, trading at the close actually gives you better results. So this is a case where you think that you might want to capture intraday profit. It sounds a wonderful idea, but unless you backtest it using tech data intraday, you would be losing money. So you have to be very careful in switching between a end-of-day strategy to a intraday strategy, even though you think that the limit order will work just as well intraday, but it doesn't because of this kind of phenomenon. Okay, so that is basically the 4 strategies. So let me take some questions about this last strategy.
Yeah. Okay. From one from Clay, and that's pretty well all I see so far. Oh, and I even had another question.
Clay, has a question about getting around the issue of using bar data for state data as a 5-minute bar frequencies. Yes. So sometimes adding slippage is not the complete solution, and the reason is that adding slippage only means that you add a penalty to a trade that you see in a 5-minute bar. But what about those trades that got triggered that you don't see that are losing? Right? Those trades will not be captured. Those losses cannot be captured by a slippage. So even said that CSI data have closing bid ask. That's interesting. Even I actually subscribe to CSI data. I've never seen closing bid ask, but if you say they have, I will certainly take another look. Thank you for that observation.
Anyone else got questions? Just type them up in the chat. Anybody? No? Okay. I guess.
Okay.
Oh,
great. Thank you very much.
Dave just squeezed in a question there. How would you define LFT?
Low frequency trading. Well, I think that a strategy. Well, that this is of course a very nebulous definition. I would say that anything that trade one round trip a day, that's low frequency.
Anyone else? No? I got a question for you, Ernie. Oh, there's one. This is from Julian just asked a question.
Mm-hmm. Okay, is that the last question? Yeah, let's see. Take a look at that. Real-time data cleansing. If we do something like interpolation to make it untrigger bad signal. Yes, you might do that certainly, but there's a problem in that there are some real trading opportunities, of course, that you will also get rid of if you don't trust the data, right? If suddenly there's a drop in the prices, well, how do you know that this is a mini flash crash where it will mean revert a few milliseconds later? Well, how do you know that it is not a permanent drop where it's a real drop where you can execute at that price and it might go lower still, right? So that's a problem with data cleansing in real time, is that you are sometimes throwing out the baby with the bathwater. Gerardo, the name, I have two books. One is called, well, let me type it in. Actually, if you go to my website, eppchan.com, you'll see my books. So you'll find the links to my books. So my website has all the information about my books.
eppchan.com.
Yeah.
So Julian
has another question. Does it distort the result? Yes, you are referring to the real-time data cleansing. Yeah, it certainly distorts the results. And but of course, the good thing about using high-frequency data to backtest, using tech data to backtest, is that you can also test your real-time data cleansing algorithm. If you are able to create a real-time data cleansing algorithm that works, then all the power to you. And the only way you can discover whether it works or not is by back-testing your filter using tech data. So you will know if it create better results or not. So that's a good argument to try this strategy, but try this strategy with a tech data set in order to test your data cleansing tool.
Anybody else got any questions? I got one question for you, Ernie.
Okay.
Okay. I've had my discussions with Len and Quan about this. Just want to get your standpoint. In my case, being, let's say, a retail trader, I'm working with tick data coming in from IQ Feed. And if I use Interactive Brokers as my broker to execute that data, is that a wise move? Len and Quant said no, you should always use the data that comes in from your broker to keep it in sync. What's your standpoint on that?
Depends on what instrument you are trading. If you're trading instruments such as futures and stocks, and you are backtesting using the IQ feed data, then certainly you should use IQ feed as a live data feed for your trading signal, because the actual execution prices are generated from an exchange, maybe from 50 exchanges, but that's nothing to do with IB. Right, whatever the prices are, IB did not generate them, so there's no reason why you should use the prices provided by IB to generate your trading signal. So, but if you're trading Forex, that's a completely different issue, because the prices from IB are from their own Forex market. That market is different from anybody else's market. Every Forex broker has their own pool of liquidity for Forex. There's no Forex is an over-the-counter instrument. Everybody can set their own price, essentially. It's a wild, wild west.
Right.
So in that case, you definitely should use IB's prices for triggering, and use IB historical price for your backtest as well.
Okay, so but in terms of so for the only asset class to really worry about, to stick with the broker, is only really Forex I need to worry about. Anything else I can sort of use, because I would assume it's slower moving and so on and so forth?
Yeah, that's correct.
Okay. I know Mark had some questions for you here. He asked about the slides. They're going to be up on our meetup group, or you said Quantopium has them as well, right?
Yeah, Quantopium has my slides, and also I have written an article that is based on this talk on my blog. So if you just go to my blog, you would see all the figures and probably explaining more carefully the points that I make there in the talk as well.
And Tony had one last question as well.
Yeah, the strategy that I'm trading, there are 5 or 6 different strategies, but the one that is the highest return is the Forex strategy, and that's the strategy I'm using to manage separate accounts. So you can see the performance on my website as well. And that's certainly a very profitable strategy. That is actually available for the general public to subscribe to. I mean, subscribe in the sense that I can manage the account with.
Anybody else? Welcome to everybody who said thanks. Anybody else got any questions? Anybody? Because we're just passing over an hour. Thanks again, Ernie, for doing this.
Okay.
That was really good. I learned a lot as usual. Lots of thanks coming in.
Thank you, guys.
James and Dave.
Good questions. And good luck trading.
Yeah. Any last minute questions at all? Oh, as usual.
There's one.
Julian asked.
Your intraday strategy is going to offer by performance shown. Let's see. Your intraday high frequency strategy is going stable and profitable. And can you tell us more about expertise? I'm not certain what exactly you mean, Justin. What do you mean by tell you more about expertise?
That I wouldn't know. Julian, if you want to rephrase that question for Ernie, referring to the experience, just type away. If you want, I can unmute you if you like. Let me just do that. Yeah, here. Hi, Julian. If you want to verbalize, you can speak. Julian?
Oh, yeah?
Yeah, go ahead. Ernie was just asking your experience. How you mean by that?
All right. I'm very curious about I read about your books, and maybe if you don't mind, you can tell us more about your experience for the business you're doing for your high frequency trading.
Mm-hmm. First of all, it's not really a high-frequency trading strategy. It's an intraday strategy, but it doesn't require exiting and entering in a matter of milliseconds. So its average holding period would be a couple of hours. So by no means high-frequency. the experience is that, this is a mean reversion strategy. And so as with all mean reversion strategy, it's essentially short volatility. So it can get scary when the volatility suddenly pick up, like when there's a crisis somewhere in the world, whether it's financial or political, military crisis. So that's something one has to be careful of. Whenever you see a strategy that looks too good to be true, it usually means that it is short volatility. And that's what we are trading. And now we have tried to cut off the tail risk by imposing a stop loss. So that will help because Forex market is open essentially 24 hours and we don't hold positions over the weekend. So, chances are we won't suffer too much tail risk and the stop loss will get rid of that. Now, some stop loss won't work, like if you are trading the Swiss franc versus euro, stop loss is no help because the government move it 10%, 20% in a matter of a second. So all the stop loss is blown through. But in our case, we only trade currencies that are not pegged. Because they are not pegged, at every minute, essentially, the market is determining the equilibrium, and hopefully there's this 10, 20% gap is not going to occur intraday. So, but nevertheless, one has to be always mindful of the nature of mean reversion strategy is that there are tail risk and you are shorting volatility. And we did get caught on the wrong foot when we first started trading this strategy. We were leveraging it at 14 times leverage. We were overly confident. So overconfidence is also another common problem, and we are guilty of that as well. So when we first traded this strategy in 2011, we were so confident that we were trading at 14 times leverage without stop loss, and we got 35% drawdown promptly in 2 months. After that, we become much wiser, and we impose a whole number of different changes to the strategy, stop loss, lower latency execution software, and smarter algorithm, and lower leverage, all kinds of changes. And these are certainly have borne fruit. So even though there are many crises after that, like the Greek default crisis and this and that, we weathered it pretty well since 2012. And the currency we trade are commodity currencies, AUD, CAD, NOK, so forth. So a whole bunch of commodity currency baskets.
Tony asked a question here about your currency pairs.
Yes, that's what I'm saying. They are commodity currencies.
Oh, sorry. Okay. Yeah. Any last minute questions at all? If not, we'll just give it a wrap for tonight. Thanks again, Ernie.
Okay.
That was really good. I'm always learning. I'm sure everyone else is learning. For everyone who wants, sends some love over to Dr. Ernie Chans for doing this. Just give him there you go. Usama said some thank you. Dave, Wei.
Great. Thank you very much for everyone.
Yeah. Oh, you just got called you sexy beast. Oh, okay. I think. Oh, I don't know.
All right.
Okay. All right.
Take care, everyone.
Thanks a lot. Thanks again. And I have a webinar coming up on Monday, I believe, with Paul Cottrell. All right, guys. I'll leave it at that, and we'll say goodnight. Okay. Thanks again. Thanks again, Ernie.
Bye-bye.
All right. Bye.